Welcome back. Today we're going to be covering some of the intro concepts that go into understanding what finance really is. So, what is finance? I like to think of finance as how money is moving around. Finance is all about making decisions. Some of these decisions or some of these questions that finance answers or a financial manager wants to answer is, should we invest in something? How much should we put in our savings? If I want to purchase something, where's the money going to come from for me to make that purchase? And how much is some security worth, whether it be a bond or a stock? How much is something worth on the open market? Now, with finance, we are moving money around. How finance differs from maybe accounting is going to record those transactions. Finance, we're trying to decide what transactions to make. Within finance, there is an objective. Now, normally the objective of any business is to make money, but when we're specifically talking about big corporations or just anyone, maybe even outside of the business, the goal of anyone in finance or a financial manager is to act in the best interest of the shareholders. Your shareholders may be everyone who owns stock. It may be the sole owner of the company. Maybe the company is owned by a few different people, which we'll see later. Our goal as a finance manager or when we're working in finance is to act in the best interest of shareholders. Acting in the best interest of shareholders means we increase the value of what they own or the part of the business that they own. And that just means if we're specifically talking about stocks and corporations, the goal of a financial manager is to make decisions that will increase the stock price. Some important terms that we'll go over. This is a big concept, and it's a law regarding corporations and businesses. It's called the Sarbanes-Oxley Act, sometimes called SOX for short. In the early 2000s, you might have heard of companies called Enron. They're probably the most notable company associated with corruption or fraud. What they were doing was they were lying on their financial statements to make themselves look better. So that way people bought their stock and they made more money. The Sarbanes-Oxley Act is a law that says basically investors are not going to be responsible if management does things that are illegal. So if management lies on their financial records, the investors are not going to be held responsible for that. Management is going to be held responsible for that. And management is responsible for keeping their records accurate and honest. Next concept we're going to talk about is the agency problem. Now, an agency is a relationship between stockholders and someone else. So, a manager of a company has an agency relationship with their stockholders. Now, we want management to act in the best interest of the stockholders. That's the goal of finance. But what if the best thing to do for the stockholders is to shut a company down or to sell everything off? Well, now that manager is out of a job. So the agency problem says that management may prioritize their own career or the survival of the company or their own personal interests over the interests of the shareholders. Next, we'll talk about the primary market. The primary market is people buying shares directly from a business when they issue them. So a business is fully private. Maybe it's owned by one person, and they say, I want to raise some cash. I'm going to sell off a part of my business. And the people that they sell it to pay them money for those shares. And that is a primary market transaction. Think of an initial public offering. So a company decides they want to go public for the first time. That is a primary market transaction because we're buying equity in a company or shares from a company directly from the company. The secondary market is people buying shares from other people who already have them, not directly from the company. An overview of this would look like this. So in a primary market, a business is going to sell directly to investors. Think about Shark Tank. Those are all primary market transactions. A business comes in, they want to raise some money, and they sell off ownership in their business to get that money. Now, those investors may sell their shares that they own to other people. That is a secondary market transaction. And in the secondary market, people are buying and selling shares or securities between each other. Now, the business may buy back those shares eventually, who knows, but your E-Trade trades, if you have an E-Trade account or if you open up a stock account and you start buying stocks, you're going to be buying stocks from the secondary market and you're going to be partaking in the secondary market. Some final terms that we'll go over, some different types of businesses that we're going to see. We have a sole proprietorship. It's owned by one person. Easiest to start, it's the least regulated. A partnership is owned by two or more people, which are referred to as partners. In a partnership, the partners share whatever money they make and whatever money they lose. A corporation is its own legal entity. You have to go through a big process to get the status of corporation. And a corporation is just like a person, and it is separate from the owners. So a corporation is owned by shareholders, and it's separate from them. So I can sue a corporation, but I'm not going to be able to sue the people who own stocks of that corporation. Corporations can own things just like a person would. They can sign contracts just like a person would. They can be sued just like a person can be sued. And sometimes corporations are called joint stock companies or limited liability companies. You might have heard of LLC. Sometimes you'll see that on packages. That's just another name for a corporation. A stakeholder is different from a shareholder. So a stakeholder is someone who does not necessarily own part of the company, but they still have a personal interest in that company. A company's employees would be stakeholders. People who have loaned money to the company would be stakeholders. And that pretty much covers the entire intro of finance. There are no equations or math associated with this lesson. So next up will be financial statements, and we'll cover some concepts relating to that. Thanks for watching.